Hi, welcome to Forex in 4. I'm Mike Conlon for FXEDU, and in the next 4 minutes, I'm going to show you the highlights of where the action is in today's Forex market. So let's get started. Good morning. Today is Friday, November 12th, 2010. This morning we're talking about Irish sacrifice. Basically, I'm asking if Ireland has sort of become the de facto sacrificial lamb of the euro. And we're taking a look at the euro chart here. Okay, you can see real quick, this is a 30-minute chart. Euro's been falling out of bed as of late, right down to 136. But when it opened earlier today, it shot a little bit higher. I'll tell you exactly why all that was happening here. But first, I want to tell you what's been going on in the eurozone. All right, basically, after quantitative easing 2, QE2 happened here in the U.S., everything but the dollar was strengthening. So euro was moving higher, as is pound, all the other currencies, commodities, you name it, on what's bound to be the inflation trade. Well, then all of a sudden we started hearing about problems with Irish debt and what's going on there, that potentially they're not going to be able to service it, what have you. Adding fuel to that fire was Chancellor Merkel from Germany, who said, hey, you know what, bondholders may have to pick up the slack here, and they may have to accept some losses on this. Well, the problem with that statement is that, back when the ECB set up the emergency facility, all right, that was, intended to, let bondholders know that they're not going to lose out on this and that the EU is going to back these bonds. Well, now all of a sudden they're changing course. So what did that do? Of course, that sent bond yields higher in Ireland, also in Portugal. All right, those yields went sky high. All right, we also had Spanish bonds going higher, as well as Greece. Well, Greece has already accessed the emergency facility, so that's no surprise there. But, the idea was, that all of a sudden the euro was in jeopardy again, and now all of a sudden the euro started falling. Well, why would she do something like that? Well, when you look at today's GDP figures and realize that they came in a little bit less than expected, all right, you're going to realize that, the reason that the eurozone had been kicking, been doing really well on the economic front as of late was because for a while there, they were operating with a euro at 120 versus dollar, 125. Now at 140, it's a little bit harder for them to conduct operations. So, why not, play this little game of chicken here, where the market's going to weaken the euro, and we'll sort of offer up Ireland here as the sacrificial lamb. So that's kind of what happened. Well, today after the G20 meeting, which again, that thing came and gone, and there was no resolution about anything. The U.S. left there probably looking worse than they did going into it. But one of the things that did come out of this is apparently there may have been some pressure on Merkel to say, hey, wait a second, you can't back away from that promise that this emergency facility is going to bail out bondholders. All right, so she had to back away from that statement, and then sure enough, what happened? Well, boom, euro starts moving higher again. All right, so we see it bounced off 136 earlier, just as euro opened for trading at around 3 a.m. Eastern Standard Time. So that's the big takeaway here from this G20 meeting. We had U.S. going in there hoping everyone was going to sort of hop on our side and pressure China for their yuan revaluation, and that didn't happen at all. So what started off as some risk aversion in the market overnight, we had Asian markets that sold off greatly. All right, there's some talk and there's some fear that China may actually raise interest rates to try and ward off some of that inflation. So I think there was a period of time where people were thinking, well, maybe if they let the currency appreciate a little bit, that'll help thwart the inflation. They don't appear to intend to want to do that. So now maybe they're thinking that they're going to have to raise rates to pull back on inflation. So you can see what happened. The Aussie. Okay, Aussie was lower on that fear because if the Chinese economy slows down, that's going to hurt Australia. It's also going to hurt New Zealand. Okay, you can look at it basically the same chart. All right, they are China's the biggest importer of their goods, so that hurt them particularly. So we had euro strength. I just want to show you yen here too. All right, yen pulled back, bounced right off the 50% retracement level on the 30-minute chart. I'll just show you this here on the weekly. So that looks like that line held. We're going to probably see some continued dollar strength versus yen weakness there, but it was the negative correlative effect that the yen has with Asian equity markets that caused that yen strengthening earlier in the day. So that's pretty much what we're looking at. We started off in a very risk-averse mode. Now that's starting to wane, and the market's starting to pick back a little bit. So that's what we're looking at. So again, the big takeaways from this week is that the U.S. failed at the G20. All right, Germany appears to have a death wish and playing a dangerous game of chicken, sort of offering up these the weaker eurozone countries to the market, to really try and get the euro lower so that they can improve their exports. Now, I just want people to realize that, as much as we harp on China for keeping a pegged currency to unfairly promote their exports, well, Germany gets a little bit of the same effect by being a member of the eurozone. It's basically like, you take Germany, which is a strong exporter, right, and you pair them up with all of these weak pigs countries and Club Med and Club, you name it, that don't do much of anything except incur debt and buy German stuff, right? And they've essentially been allowed to keep their currency down as well. Now, if Germany had to go back to the Deutschmark, that may be another story. That they might be as strong a currency as say the yen, and they might be complaining that too high of a Deutschmark hurts their exports, and they may be following the path to intervention that Japan tried. So they might want to be careful with what they're doing, because especially with Ireland, because if the Irish realize hey, we're trying to take these austerity measures to get the debt under control, but if Germany's going to leave us out to swing like that, then maybe we're just not going to do it, and forget the whole thing, let Germany deal with it. So anyway, that's what we're looking at today. We're going to see if the markets flip around here, and if we can get these commodity currencies back up, as well as stocks here in the U.S. So that's what I've got for today. Good trading to all. As always, be sure to check out the written blog at www.fxedu.com to get complete coverage of today's Forex market. If you would like to learn more about how to trade the Forex market from professionals like myself, be sure to check out our affordable Forex trading courses. And if you're already a seasoned professional or aspire to be one, ask us how we can help you achieve your Forex goals. Go to www.fxedu.com to get started today.